we can start. Today class is really going to be a short one. It's not going to be as long as other classes has always been, because we are just going to talk about the mitigation processes. What a mitigation zone and what is an unmitigated zone, right? So that's mainly what we are going to talk about today. You get it, guys? So now when we talk about mitigation, or let's say when we talk about the smart money concept as a whole, those of you just joining now, we are just about to start today's topic. So when we talk about smart money concept or the smart money trading concept, one very important thing we talk about, or let's say one thing you often or always hear when we are talking about entries, when we are talking about change of character, supply and demand, you will always hear about mitigation. Mitigation. You always hear about mitigation. It's a common terms we use in the smart money world. And what this simply means is this, right? So we see the market moving up and down in a certain direction, but why price does those retracements when it is in a trend? To facilitate their own liquidity. Smart money traders will both be taking buys and sells positions at a certain level, and for certain reasons price will come back to the point of interest left by the smart money traders to mitigate their counter trend positions by closing them at break even or with a small loss, while making the market efficient, right? Price will come back into our area of interest to rebalance the price and have a fair price during this phase of retracement. Mitigation during this phase of retracement, which is we call it the mitigation phase. Price will build a lot of side liquidity to target after the price delivery. So now guys, what we simply mean when we say mitigation, let me go on to the chart. Can you guys see what I have on my screen, guys? So guys, now let's talk about the volume first. Now, I talked about price impulsing to the upside, and after that impulse, we often get a pullback, right? We often get a pullback. Now we are having some people that people are coming to. I said now, let's say for example, we have a demand zone and price just impulsed to the upside. We often always get a pullback back to where that impulsive move started from. Now, we always consider this level to be the origin, right? We always consider this very move that impulses to the upside the origin. What often happens is this: when price impulse to the upside, it always returns back to its origin before the main move or the continuation begins, right? So what always happens is this: price always returns to its origin to mitigate the demand or the supply that led to that move, right? The reason why this always happen is because the smart money traders themselves, let's say for example, if this was a demand zone and then price is coming from a supply, just like this, when price is coming from this supply, price is going to do what? Price is going to react from this demand zone. Once it reacts from that demand zone, if the demand is strong, then we are going to get a move like that, which simply means we are going to get a break of structure or a change of character. This is to tell you that the price has changed from uptrend to a downtrend. So now let me start. What you experience is this. You see this very demand zone, there's going to be a lot of buy order, a lot of buy limit order when price was coming all the way from this high. Are you guys following up? Hello?
Yeah, yes, sir. Yes.
All right. When price was coming all the way from this high, a lot of smart money traders, they already knew that price was coming to do what? To mitigate this demand. You understand, guys? Price was coming to mitigate that demand. So once price is approaching that demand zone, once price is approaching that demand zone, all these guys might have placed limit order just like us. You understand? We do this as well. So let me put it up on the screen and then we go straight to charts. All right. So if you look at it now, this is going to be an example. You see when price was coming all the way from this level, right? Approaching this demand, a lot of people were placing their buy limit here. That's why you see that once price started approaching the demand zone, the volume started dying out. Now, if you look at this, we had an impulsive move. Then we have a little push to the upside that was not impulsive. Because now, if you want to look at the impulsive movement, you have to look at the volumes of the candles. You see how strong the down candles were when it was dropping. But you see how weak the up candles are when it started retracing to the upside. After the mitigation of this supply, you see how impulsive the continuation candles are. We have just 1, 2 candles and price was already at the demand zone. Now, when price approached this demand, the volume started dying out. This is to tell you that all the sell positions were being closed because price has already approached a demand for mitigation. And before it approached this demand zone, a lot of traders have placed their buy limit order here. So once the price mitigates that demand, it then takes that order and then immediately impulse to the upside, breaking above the previous high. Let's look out for more examples, guys. Let's look out for more examples here. Looking for a more better, clean example. Let's use it on the charts. Now, once price approached this zone, all the buy orders will now be taken, and it will cause a sharp market movement to the upside. Remember what I said, guys? I said that traders, if they are entering the market at this level here, if they are entering the market at this level here, they will be taking profit at the next structure high. Are you guys with me? Yes. They will take profit at the next structure high. You get it? Now, we are always looking at structures. If we are buying here, then we should be taking profit at this high. Now, I said in the market structure class, once we start taking profits, once price breaks this high, everybody starts taking profit. What will then happen? The market will do what? Start to retrace. Right? The market will start to retrace. Now, the smart money traders themselves, they will be entering with a huge amount of money. They are entering the market with a huge amount of money. And now, what they will usually do, let's say for example, if they had their stop losses below this low, and they entered at this very point, right? They are going to be closing their positions. They are going to be closing their positions because they know that once price breaks this high, they are going to get what? A reversal. And that reversal is an opportunity for them to take even more positions. You understand? So what they usually do in this case is this. They will start to close their positions once their order has been taken and the market starts to move in their favor. They will now begin to do what? Close their positions. Once they start to close their positions, they will now move their stop loss into profit. Are you guys following? They will now move their stop loss into profit, so that by the time the market will retrace, the market will not take them out in a loss. You understand? Because now they are entering the market with a huge amount of money that they can't afford to lose. You're getting it? So they are always fast. If they are entering the market with trillions, we know the market makers, they don't trade with thousands, they trade with trillions of dollars. You understand? They trade with trillions of dollars. So once they start to close out their positions, they start to take profit in the market. What usually happens is that the market becomes weak. Once the market becomes weak, the market starts to retrace against their position. Once the market starts to retrace against their positions, that's when they now move their stop loss from this level here. That's when they will now move their stop loss from this low, and then they will now adjust it into profit. Now, price will always do what? Since there is nobody ready to buy, to push price up, price will then return back to the origin. You understand? So you know when we talked about market structure the other day, right? I said once the market impulses to the upside and gives us a change of character, then that impulse to the upside is going to leave behind an order block. We are going to talk about order block in our next class. That impulse to the upside is going to leave an order block. That order block is the area where the smart money traders themselves will move their stop loss and leave it there. And this is the same level they are going to put all their buy limits for the second time. You understand? For the continuation of the trend. Are you guys with me?
Yes, sir.
All right, all right. So once price breaks this high, or we call it a change of character, this aggressive buy is also going to leave an imbalance. Imbalances are caused by aggressive buyers or sellers. Do you guys understand? Imbalances are caused by aggressive buyers or sellers. You understand? So now the market will always reverse to fill up this open imbalance to mitigate the new demand zone for the continuation of that uptrend. Hope you guys are following what I'm saying. Now, due to the fact that these guys that entered the market, let's say they entered the market with $5 million, right? From here to there, let's just say from there to here is about 77 pips, right? Is about 78 pips. No, that's it's about 781 pips. From this entry, from their entry points to this high, is about 780 pips, which they would have made a huge amount of profit on their position. You understand? So let's say, for example, they enter the market with 5 million and they are taking profit out of the market of about 70 million or 78 million. That alone, they've made a lot of profit that they can even leverage more on. When I mean leverage more, they can take more positions on it. Remember, when price impulses to the upside and breaks a structure high, buyers will start to leave the market. And the market will become weaker and it starts to do what? Retrace. When it starts to retrace, it will retrace into a discount price level where it will attract more buyers. You understand? So the price will always return back to the origin where the impulse started from. Once the market returns back to this level here, to mitigate that demand, the smart money traders will do what? They will start to stack more buy positions to take price higher. You understand? They will start to stack more buy positions to take price higher. And once the price leads to another new break of structure, these guys will start to exit their positions so they can also come back to mitigate this new demand. So now, why this often happens is because they always return back to the entries, right? So if you see like a zone like this zone, price returns back to this zone, it is now considered to be a mitigated supply. When price breaks structure and returns again back to this supply, it becomes a mitigated supply. But any of the charts that you see that price has not fully returned to where it impulses from. As you can see, we saw an impulsive move from here. And price is also trying to return back to that level. For the fact that price is not fully inside of this level, it is considered unmitigated. Until price fully gets back there, that's when we can say it has now been what? Mitigated. Are you guys with me? Now, if you look at the example over here that I have on the screen, you see this example very clear, right? You see that example very clear. Let's look on the, let's go to, can you guys see my chart? Can you see my screen? Hello?
Yes, you can see your screen.
All right. So example is this. You see that this price broke structure. We had an impulsive move from this high that led to a break of structure, right? Price carefully returned back to this red zone, which is a supply. After that mitigation, we saw an impulsive move to the downside that led to a new break of structure. Now, this zone that this entire move to the downside started from is considered to be an unmitigated zone until price fully returns back to it. We always use these unmitigated supply or demand zones for our entries. Just example of what you can see here on gold. If you look very well, you see that we have a demand here. When price came down, price mitigated that demand and impulsed to the upside that led to the break of this structure point. Now, I'm simply waiting for price to pull back for a new mitigation, and that's where I'll be entering this trade. Do you understand, guys? So now, let's say you have a zone like this that still has an open imbalance. It still has liquidity that has not been taken. It's always very easy for you to know that price will always come back to this level before impulsing to the upside. You understand? You can see the impulse to the upside has already died out at this point, which means for price to continue to the upside, it has to come for a mitigation so that the smart money can get in at this point. The smart money traders only want to get in during when price returns for mitigation. Right now, we can see the impulsive move to the downside that has broken this low. The smart money traders will get in when price returns back for mitigation, right? On this trade, after the mitigation of this wide demand, we had an impulse to the upside. After that impulse, we saw price return back to this zone for a mitigation, and that's where we want to get in because that's where the smart money are getting in. Example is this. This is the zone. It has not been mitigated, right? We wait for price to come to this zone so that we join the smart money and take trade when they take their trade. This is the example when price has fully returned there and mitigates and is now doing what? Pushing all the way to the upside. Do you get? So hello?
Yes.
All right. So I'll be taking your questions, guys. I'll be taking your question for those of you that are here live. I told you guys this class is really not going to take much time because the mitigation process is not something that will consume our time, right? The mitigation process is easy and simple to understand, right? So we see the market moving up or moving down in a certain direction. But why price does those retracements when it is in a trend is to facilitate their own liquidity. Smart money traders will both be taking buys and sales positions at a certain level, and for certain reasons price will come back to the points of interest that was left behind by the smart money traders to mitigate their counter trend positions by closing them at break even or with a small loss while making the market efficient. You understand? Price will come back into our area of interest to rebalance the price and have a fair price during the phase of retracement, which is the mitigation phase. Price will build a lot of side liquidity to target after price delivery. So what that simply means is this. Now, this is what I want you guys to understand about this. You see that price has built a lot of higher highs here. This is liquidity. We'll talk more about liquidity. After price delivers into this zone, after the mitigation, price will then reverse to clear all these liquidities and fill up these imbalances over here. Anyone have a question, guys? Anyone have a question?
Yes.
All right, if you have a question, you can ask.
Okay, is there any conditions or anything that we that will tell us is the mitigation zone, or any well, how do we know this is the mitigation zone?
Yes, the mitigation zone is your supply and demand. So I'm only telling you how when price returns to those levels, we call it mitigation. But normally, price always come to mitigate a supply and demand zone. Mitigation zone is not different from supply and demand. Price comes to mitigate your supply or your demand. You understand? Mitigation doesn't have a zone. Mitigation is simply price coming back to your supply or demand to rebalance price and to take orders that the smart money was kept pending, to close them out at break even, or to close them out in profit, or to close them out in a small loss, and for them to have the opportunity to enter the market again for the continuation of the trend and capitalize on that move to make more profits. So when price returns back to your supply or your demand, that is mitigation for you. But if price has not fully returned there, then no mitigation has taken place. Do you understand now?
Yes.
Very good. All right, you can ask your question.
Thanks so much for the class. The question is, from these inputs you are putting on, can we get a PDF?
Yes. Everybody is going to have it. The main issue is I'm still working on it. I'm still adding more subjects. I don't want to do a half job. When I deliver, I try to deliver what will be useful even in the future. I want to finish working. I'm still adding more subject to it. You understand? So once I'm done, I will send everything to everybody. So there's no need to worry about it. You understand? I'm still working on adding more things, more topic that will be useful. You understand, guys? So we have 1 minute left. Any other question?